Dear investors, it's again Friday evening, and this is the weekly Vinley Radar news roundup. So you're gonna see this week we're gonna cover again the largest companies in the world that have been reporting earnings. It was a very busy week, an interesting AI story, and as always, I'm gonna be starting very rapidly on the macroeconomic elements. So some of you may have heard that Wednesday afternoon, the U.S. Federal Reserve under Chair Kevin Warsh was his second meeting chairing the US Fed. So the US Fed has decided to keep interest rates steady, despite some concerns nonetheless related to inflation. We had also US GDP figures that were a little bit below expectation at 1.5% instead of 2.1 estimates. But you know, I'm not a forecast guy. I don't like this type of things. And then the jobs, the claimless jobs were growing a little bit compared to the previous week, but nothing, in my opinion, to be worried about. And you're going to see in general that actually the results of most of the companies have been pretty strong. One story that I want to pick out is the following one. Before I go into large companies, is because if you remember, and I've already been discussing this multiple times, also LinkedIn posts, about the risk related to the AI bubble, and I'm not the only one. I mean, many people are looking at this circulatory system where, for example, NVIDIA invest into companies and they get then revenue. So I mean, there is like a closed loop on everything that's related to AI and GPUs, those type of things, and also cloud computing. An interesting fact that I wanted to share with you is there has been, I think it was Thursday morning, a huge fire sale that happened on, if maybe you don't know this fund, called Situational Awareness Fund, which was a fund that was run by a former OpenAI employee, I think researcher, Leopold Aschenbrenner. I've put you the picture here from the guy, where the fund had been growing from 225 million up to 45 billion in under 2 years. So, I mean, respect for him, very successful. And the fund had to sell. So the fund has been sold to Citadel. The reason was that, and actually I'm gonna move my mouse here. The reason was that a lot of holdings that this fund was having, they lost in July between, let's say, minus 40% to minus 20%. Is that a problem by itself? No. Except if you have been borrowing money, because you will then get a call from your broker who's gonna say, well, your position has been in fact taking a hit, so we need to secure this as well. So the money that you borrowed from us, well, you need somehow to sell assets or to bring in cash to cover your position, which is what is called a margin call. And so this is exactly what happened. So the fund has been sold, so from an initial valuation of 45 billion, has been sold for 10 billion. What is interesting is that 6 days earlier to this sale to Citadel, that so Aschenbrenner had urged investors, because of the drop in share prices of companies like SanDisk, CoreWeave, Bloom Energy. I think Bloom Energy is a fuel cell company. Nebius Group is a AI cloud provider specifically. So he was actually calling investors to buy more and calling it the best opportunity since 2025 to buy more shares. But unfortunately, what happened is that nobody has been putting more money into the fund, and so the fund has run into a liquidity issue, and they had to sell off. You know what this reminds me? Maybe some of you remember the movie Margin Call with Kevin Spacey, and this is exactly what happened. And I want to repeat, and I'm sorry for insisting on this, on the left-hand side, in my course, The Art of Value Investing, and by the way, there's going to be a book called The Art of Value Investing that will be coming out on Amazon in a couple of months that summarizes my whole methodology of investing. Actually, one of the 5 attributes in the mindset of a serious investor is and I've just taken a screenshot of the other value investing, is zero leverage. Never borrow money to invest into stock markets. And this is exactly what happened here. The guy has actually had too much risk appetite, and unfortunately the market turned against the funds, and then you get this margin call. So there were three brokers that called and said, well, sorry, you have to cover your position. So as always, I know that it is very tempting to borrow money, specifically when you are successful, to get even more rich and wealthier. I stick to my position since 25 years, never borrow money in order to invest into stock markets. So this is really, really super important. Okay, having said that, I want to cover the first company. So this is a company I have in my portfolio since March, actually. If I remember well, I bought the stock, I think, $337 US. The stock is now worth a rough cut, I think, $400 US. And I bought actually into the company because the company has a strong moat and it was cheap at that time, given the growth, let's say, projections that I had about the company and the cost of capital. So Ferrari posted their earnings this week, so of course I was very keen to hear their results. So the revenues were good. I mean, they had revenues going up by 11% at constant currency, and the operating profit also has been growing by plus 10% year over year at 605 million, which makes a very solid margin of 31.2%. What has been driving the growth of Ferrari over the last 6 months? Remember that Ferrari, as a European company, only publishes once every semester financials and every quarter a sales update. So, of course, and this is very similar to Porsche, a personalization of cars. So the very wealthy people who buy Ferrari cars, they want to have a unique car for the money that they spend. So they're gonna spend money on personalizing the car. There has been a stronger sports car mix. I will speak about this in 2 slides after showing you the results of Porsche. And also, I mean, for those who follow Formula One, I'm a Formula One fan. You know that one or the other let's say Formula One team this year has, so there are more Ferrari engines. So the Formula One engine rental has been also contributing a little bit to the growth in the revenues of Ferrari. Very interesting, something that I really liked, which also, just to explain, tells me that I will not be selling my Ferrari shares, is that their order book is already full for 2027. So, which is great news. So they actually even have been, and this doesn't happen very often, this really only happens when management is very, very confident and comfortable about the forecast. They have been even raising full fiscal year guidance from 7.50 billion to 7.60 billion, and even the earnings per share have been adjusted. So they plan that instead of being at 9.45 euros per share of earnings, to be at 9.68. So all in all, pretty okay. The market did not overreact, to be very honest. The market had already been running in favor of Ferrari over the last months. I mean, I bought Ferrari in March. We are now end of July. And so I already had like plus 20%, excluding dividends, as always. So I would need to add dividends on top of that. It happened during springtime. So this is, for me, a very nice position just in a couple of months of having reached more than 20% performance. Porsche, which is, again, in my portfolio, full disclosure here, is one of my largest positions. I think it's rough cut, if I remember well, like between 15 and 20% mark to market on my current portfolio. The results were okayish, I have to say. So you may know that they have a new CEO that is coming from McLaren. And so the guy has stabilized profitability, which is good. So actually the group operating profit has increased from 1 billion euros to 1.3, which is pretty solid, I have to say. So the guy is really, let's say, optimizing costs, cutting costs. Of course, this does not come as a free lunch. So there have been jobs that have been cut, unfortunately, for the people being involved. I mean, there are in the 2035 plan of Porsche, there are 9,000 job cuts that have now been announced. I think the last job cut that has been announced was July 27th, with another, I think, 5,000 jobs where there was a, let's say, an early retirement and job cut plan that has been agreed with the worker unions as well. In terms of revenue, that's, of course, something. I mean, you can, of course, and I'm always saying, to make a company profitable, you have 2 options. Either you grow the revenues or you improve the costs. So here the guy is improving the costs because, well, Porsche management doesn't have the choice for the time being. And you see here the comparison with Ferrari. The revenues are going down. But there is also an explanation to this. Let me just show you the next slide, which is a specific slide that I prepared here. So one thing that I think, this is what I'm always saying as well in my courses and my upcoming book, that you need to understand the business that you invest into. There is a key difference between Porsche and Ferrari. So, okay, let's agree that Porsche and Ferrari are, okay, maybe Porsche is like high-end or entry level of luxury versus Ferrari really being luxury. If you look at the number of units, Ferrari sells or has sold over the last 6 months 3,300 cars, while Porsche has been, don't remember the exact number, selling 132,000 if I remember well cars. That's a completely different game in fact, right? Also in terms of property, plant and equipment, so the engine, the manufacturing chain, the distribution network is a different thing. But so that's one thing, first of all. So you see that Ferrari, and this is something when I teach as well to my students, I say volume is not necessarily the best strategy. Sometimes you better are in a small niche, but you are super profitable, for example. And here Ferrari with 3,000 units is of course in a completely different league versus Porsche with 130,000 units over 6 months. Now, there are nonetheless two more things I want to add here. Ferrari has had since many years a very clear strategy of making products unique. Why? Because when they come up with a new product, the product will not stay for 7, 8, 9, 10 years, in fact, in let's say in production. They're gonna be coming up with new models. The models will stay for a smaller amount of time. Then they're gonna be phasing them out, which makes them desirable as well before production stops. And they are bringing in new models in, including the very controversial Ferrari Luce, the first electrical vehicle of Ferrari. While Porsche, if you look on the left-hand side, so Porsche has, I would say like rough cut 6, and I'm not a Porsche specialist. I mean, I don't drive Porsche, nor I drive Ferrari, but as a shareholder in both companies, Porsche has so is still high-end, so are less attacked in my opinion versus other more like mainstream brands where they suffer a lot from Chinese competition. But here you see that the 911 Porsche has always been the battleship of Porsche. What is nice here in the last results of the first semester is that you see, in fact, that the 911 has increased by 19%, which is great because that has always been the lighthouse model of Porsche. Porsche has also, I mean, over the last couple of years has brought also specialization, has brought also uniqueness about some models as well. You need to have, I mean, you cannot just buy the latest 911 GT whatsoever if you have not been a Porsche customer. So they're creating desirability of the product as well, but I believe that Ferrari is a little bit better on desirability still than Porsche. On the decrease in number of cars shipped as well, just be aware that the 718 and the Micron are being in fact discontinued as well, so something not to be forgotten. So just wanted to share this with you, so because we are not really speaking about apples versus apples here. Just look at the amount of units that are being sold between Porsche and Ferrari. It's not the same type of industrial vehicle that those two companies actually carry. Another one that I carry in my portfolio as well since a couple of months only, have to disclose this, is Microsoft. So I invested into Microsoft a couple of months ago. I think it was also around the March time when Anthropic Claude's latest model actually created a huge AI panic and everybody was selling tech stocks. And if you remember last week I was speaking about SAP, the German ERP global company, and I have SAP in my portfolio. Again, very successful over the last 4 months. I think as well here I have a, I don't remember now exactly, but a plus 12 before dividends position just in a couple of months. Microsoft is the same. So I have there also, I mean, pretty solid also, at least plus 20% over the last couple of months. Pre-dividends, so this excludes dividends. So the results have been very solid. So a lot of people, now we'll cover the CapEx thing here specifically. A lot of people have been worried about, you remember this circular economy around AI investments and companies investing into other companies, and those companies would then buy either hardware or software from that company, investing into the company. So, so the revenues have been at 90 billion, so pretty solid in fact. So for the last quarter, 18% year-over-year growth. Microsoft Cloud extremely solid with 27%. And as always, Azure very strong. I have to admit, we use, I mean, Vinley runs on Azure as well. And also the Copilot is picking up, so more and more customers are paying for Copilot services. Operating income very solid at 18%. And so, I know Microsoft. I mean, I have been working myself 12 years at Microsoft. I learned so much at this company. I love the company. And at the same time, I know that Microsoft management has always been very, let's say, strict. And Amy Hood as CFO as well, how they run also their costs. So despite great results, they have been decreasing the headcount by 2%. So that's definitely something, and some of you may know that there has been an early retirement program also going on at Microsoft. In terms of AI investments, that's really a worry for a lot of investors. So the operating expenses have, of course, increased, and I've put you some graphs here related to CapEx. So cash spend and CapEx, which includes also financial leases. So the main conversation that is going on AI now is, I mean, there is a huge demand to run those large language models, and you need a huge amount of compute capacity and data centers. So when you look year over year, you compare the fourth quarter of the year fiscal 2025 Microsoft versus the fourth quarter of the fiscal year 2026, you see that the cash spent by Microsoft on property, plant, and equipment, which includes, of course, data centers and compute power behind, has doubled. So from 17 billion to 35 billion. And when you look, in fact, at the operating cash flow versus the investing cash flow overall, actually, so in the last results that Microsoft has presented, from the 55 billion of operating cash flow that they have generated, 54.8 billion, that's like 96%, has been reinvested. So the company is spending huge amounts of money in investing into their future. We will see if the bet will pay off, as I already said a couple of weeks ago and last week as well. We don't know, but you see that the company is still increasing their amount of spend. But investors have considered this to be serious numbers. I would recommend you to look at the Meta platform numbers, where the stock has dropped, I think, by 30% over the last couple of weeks. Why? Because even, I think they published their results this week, Meta, and I think that they have announced to the markets that their cash flow would turn negative, which is something, of course, that investors don't like to see. And there is a conversation, if you remember, I mentioned this last week, there is a conversation about special purpose vehicles, which for me resonates like, okay, I remember the story of Enron a couple of decades ago, where part of the debt of Meta apparently is sitting off the balance sheet, which is something I don't like. Okay, so this is for Microsoft, so pretty solid results, and the market reacted by plus 18. I think it's even today, we have Friday evening, plus 19% on the share price of the last 2 days. Then, I mean, for those who follow me, you know that I like to invest into luxury companies. I had invested very successfully into Richemont, sold it nearly multiplied by 2 just within 6 months. And I have now, since already 3 years, Kering in my portfolio. So Kering is the company of Gucci, Balenciaga, Alexander McQueen, and also have LVMH and Christian Dior International, which is the holding of LVMH as well, in my portfolio. I don't own Hermes, because Hermes has always been extremely expensive. And I will speak about Hermes in a couple of minutes. So overall, of course, we all know with the situation between Iran and in the Middle East and the US and Israel, that part of the Middle East spend on luxury is not happening. In fact, we all know this. So luxury, and you're going to see this in the next slide in the graphs, luxury markets have been punished, in fact, and luxury stocks as well, with a little bit with the exception of Richemont, to be very honest. But okay, what were the results this week? The 3 companies this week have published their results. Kering, with a new CEO, Luca Di Meo, who is the former CEO of Renault, and he did great work at Renault, is actually had a pretty solid and serious results. Gucci is still a decline on revenues, but it's getting better. So I would say I think that we are in a turnaround situation at Kering, and the market reacted very positively. So the share is again back at nearly 300 euros per share, if I'm not mistaken. LVMH, Results were, solid. LVMH is, I have it. I have a strong position in LVMH as well. I really love all the brands that they have. I even believe that a lot of their brands are even stronger brands than the Kering brands. And so the results were okay-ish, and the market didn't overreact nor underreact to it. So the market has been kind of saying, okay, well, we'll keep it flat. LVMH, we were expecting this. But again, I will show in the next slides how to read not just the earnings, but how to look at the companies as well. And then Hermes published as well correct results, but the market really punished Hermes with more than minus 10% on the share price. That was actually their worst single day in over 15 years. But there is an explanation to this. So, and I wanted to share, and I hope this slide comes across very well on social media and on YouTube. I wanted to share with you what you have to look into. So on Kering, the share price has been punished before Luca Di Meo came in. So the results were not good. Gucci had huge declines in revenue, and Gucci is the cash cow, at least for the time being, of Kering. So the share price, and that's one of the reasons why I bought into Kering as well, is that it was cheap to me, in fact. So I already sold part of my position when they went above 300 euros a couple of months ago, if I remember well, 9 months ago. And nonetheless, there is still one concern. If you would read the Kering results, the amount of debt of the company has been reduced. So Luca Di Meo is also a little bit like the guy from McLaren that is now the CEO of Porsche. Sorry, I don't remember his name. I should know his name as myself being a shareholder of Porsche. But Luca Di Meo is really, really also seriously trying to turn around the Kering group. And I really like, and the market is also reacting positively to it. Of course, now, if you look at the valuation of the company feels like overvalued because the earnings are not still there. And when you look at the solvency and the financial strength and you compare it, so I've took here screenshots from Vinley. If you compare the solvency and financial strength, three main metrics, which is bankruptcy risk, debt to equity, and interest coverage ratio, well, for the time being on Kering, they are not as solid as LVMH and Hermes, right? So if you would just look from solvency and financial strength perspective, LVMH and Hermes, it looks like the earnings are not manipulated, so those companies will not go bankrupt, right? So I have heavily invested into LVMH and Kering. And I have to be fair, when you look now at LVMH feels cheap according to Vinley. And again, as always, never solicitation for you to buy or sell when I share the Vinley Radar. But according to Vinley, well, currently LVMH seems to be a little bit cheap based on the sensitivity analysis that Vinley has been doing. So while Kering, because we are still waiting for higher earnings, is still considered overvalued. And Hermes, and that's one that I have to say, I have been observing. You see on the right-hand side that, so Hermes has nearly lost 50% over the last, let's say, a year, a little bit more than a year, let's say a year and a quarter, so the last 5 quarters. They actually peaked at rough cut 2,700 something, 2,800 euros a share, and now they're at 1,500. So, and from a solvency perspective, they are okay, but from a valuation perspective, according to Vinley, they are still a bit expensive. So let's see. I'm observing Hermes. I have to be honest. I like the strength of Hermes, and when I speak to women about luxury, they clearly put Hermes before LVMH and before Kering. So, a lot of women consider that Kering with Gucci is, in terms of even of quality, not as good as the LVMH brands or Hermes brands, for example. Balenciaga is a little bit controversial as well, the type of, and I'm not against influencers, but the type of influencer that you see on social media, they like to brag with Gucci, with Balenciaga clothes. So it's a different type of customer base as well, in fact, compared to brands at LVMH or Hermes, in fact, carry and the attributes of those brands. Right, I think this is the last one I want to cover this week is Coca-Cola. So Coca-Cola has been posting great results again. Of course, part to their campaign that they have been running across 180 markets with the FIFA World Cup. So the amount of unique case volume has increased by plus 5%. Company is very solid on financials. I've put here the extract of the fundamentals of Vinley and also in terms of valuation. Nonetheless, they feel expensive now. And you remember Warren Buffett has still 400 million shares of Coca-Cola. So of course, this is good news for Berkshire Hathaway as well with such results. So considering this, I mean, they even raised the full year guidance by 1 point if it is on revenue growth and also on their earnings, in fact. So very solid. I mean, I do remember even in the very first version of the Art of Value Investing training, when the stock was at 54, 57, I was mentioning that at that time was a little bit cheap. And so now, and Vinley clearly shows this as well, I honestly believe that Coca-Cola is now pretty expensive. I mean, me personally, I would not now invest into Coca-Cola except if something would really change. But for the time being, for me, it's like a no-go to invest into Coca-Cola. But great company, great financials, very solid on solvency, very solid on profitability. So very decent as well on passive income and dividend payout ratio. So yeah, I think a strong company from a financial perspective. So this wraps up the weekly Vinley Radar news roundup. I hope that you like it. As always, if you like this type of format and this helps us and the channel to grow as well, please like the video. Feel free to comment as always, and of course to subscribe to this channel, and talk to you next week for the next weekly Vinley Radar. Thank you very much and enjoy your weekend.